An entity, being a company or self-employed or any form of business, needs to analyze and handle wisely its working capital. It's an accounting term that refers to the liquidity of the business within a short-term period, that is of 12 months. Liquidity refers to ease an asset can be turned into cash. It is not just important to have a bank account for the business, but what is essential is how it is used. Apart from that, one has to strike the right balance for the other variables falling under the working capital. That is the inventory, current assets, which include any amounts due to business from customers, and current liabilities, which include any amounts due to suppliers from goods and services rendered to the business. It is of utmost importance that the business takes care of having enough balance in bank to settle its debts, with respect to suppliers to run the business, wages, due to the government, and other commitments that it may have. In order to be able to make such payments, one has to chase its customers on a regular basis to pay on time what is due to the business. It is an ongoing process that has to be maintained under constant watch. So what we have been discussed so far can be summarized as working capital is current assets less current liabilities. At times, business operations are not evenly distributed over a calendar year, so the business cash flows will not have the same inflows and outflows matching because of seasonality. This means that the business activity may be experienced substantial inflows during the summer and then a slow-moving winter. So one has to keep enough liquidity for the winter period. Irrespective of the seasonality of the business, commitments with third parties have to be respected in order to maintain credibility. In case of shortages in cash flows, one can request the bank for an additional working capital, that is, a bank overdraft. This will increase some charges to the business, but it will help to ease any temporary difficulties that the business can encounter due to slow-moving periods, or when a need arises to place a large order and there are not enough funds, or when the customers are taking longer to settle their dues than planned. The more years that passes, the more a business can understand its cash flows fluctuations, and so it can plan better. So how a business can evaluate its working capital? This is done by taking the total of the current assets and divide by the total of current liabilities. The evaluation has to be done in the form of a ratio, and it will indicate the business ability to pay its current liabilities with its current assets. Also, the calculation of the formula. If there are any stale amounts from debtors or inventory which is obsolete, or now it is out of season or fashion, and can be sold at a much cheaper price, then the current asset side of the calculation needs to be revised to reflect the actual working capital of the entity. For example, if the current assets amount to €500,000 and the current liabilities are €250,000, then the result is of 2:1, which indicates a healthy ratio. Basically, this shows that for every €1 of liability, there are €2 of current asset. The less the ratio is, then the current liabilities will be less covered by the current assets. If the result is less than 1, then the business should think of how it can revamp its business, or considerations of how to collect the amounts from clients. If it is of something temporary due to seasonality, or a one-off thing because there is a valid reason, and this will not happen again, the business can try to get an overdraft to bridge the shortfall. The working capital tool is an important measure for a business in order to assess whether it is going to encounter any issues with its short-term financial obligations, to address any unforeseen issues, and to be able to plan ahead to generate new opportunities.